So you've been wanting to research companies, but you don't necessarily have the time to do it yourself, or you don't know how to do it yourself. In this series of videos, I'm going to be going step by step through my entire process from beginning to end on how I find companies, what I look for when I do my initial research on the companies. If they pass my initial research, how do I value and evaluate them after reading their financial statement? I will go step by step, including valuations when we get to that point, and how to evaluate companies. My name is Jason Rivera, and welcome to Value Investing Journey Case Studies. Hey, Jason here. In today's first preliminary analysis of this, what's going to be an ongoing educational and hopefully we find great investments from this series as well. A great value investing ongoing case study, long-term case study. We're going to be going through companies one by one, and today we're going through my preliminary analysis checklist on this company right here, San Miguel Corp ADR, SMGBY is the ticker. Okay, so what I do here is I bring up the key ratios tab, bring that in a new tab. I've already done it. Same thing with the financials. I get the key ratios tab right here, income statement here, balance sheet here, and cash flow statement here. I get these all open, leave them open, and then we go through the preliminary analysis. So 6.47 billion. So first thing I want to make note of here is this is in US dollars, but the numbers down here, when we get to down here, will be in Filipino pesos. We do not, or I do not, I know some people do it differently, I do not switch and transfer or convert, convert Filipino pesos or any foreign currency into US dollars until we get to the valuation stage. I do this because I found it to be incredibly confusing, having to convert every single number. Not only confusing, but also very incredibly time consuming to convert all the numbers all the way throughout. So instead I just convert them at the valuation stage and in the notes down here, and it actually won't make a huge difference now. But when we get to the kind of later stages, if we get to the later stages on this company or any other kind of foreign companies, we will need to remember to convert them to US dollars if you're in the United States. So having said that, 6.47 billion, 0.9% dividend, trailing 12 months. And I'm going to go through this kind of fast and not explain too much. If you want to learn in depth what these kind of things mean, I teach this to my students in the master class, the training vault, and the $10,000 coaching program. So if you want some of those more in-depth explanations, you have to subscribe to those programs and services below this video. But if I was to do that in every single video, it would take up an enormous amount of time. I've got 86 videos over 13 hours in the masterclass. I do one-on-one training sessions in hour-plus long training sessions in the $10,000 coaching program, and we've got easily more than 100 videos in the training vault at this point. So it would take up an enormous amount of time to do that. So that's why I'm not explaining things too in depth in these initial preliminary analysis videos. So 14.9, 5-year average, I do not use the trailing 12-month numbers because this isn't a full year's numbers, or either that or it's overlapping partially on this year's numbers. So I go back from here. So 15.4 plus 12.9 6 plus 7.5 plus 6.2 plus 7.6 equals 5, so 9.9%. Share count has fallen pretty drastically since 2007, which is fantastic. 348 from 348 million in 2007 to, what is it, 238 million, 238 million in that period, overall fall of 48. It's 32%. 32% in that time. That is fantastic. Means they're buying back shares, and again, fantastic. That's, yeah, I don't look really ever for shares to rise unless their share prices are massively overvalued, which we'll find out a little bit down here. Typically you want them to buy back shares when their company or when their stock is undervalued. And again, we'll find that out down here further. Book value per share has risen substantially again, so 9.09 per share in 2008. Oops. 8 to 22.9. Of 252% in that time. Again, fantastic. So what was the next number? ROIC down here, 3.8%. I'll explain this in those other videos more in depth, and those other products and services more in depth, and I'll do a brief explanation of everything I look for at the end of this video. Right now I just want to get all the numbers down. So 5-year 4 plus 2.4 plus 2.8 plus 1 5.2 equals, so 4.4%. 5 year 4.4. ROE 6.1 trailing 12 month. Because this number is higher than this number, I automatically can tell this company has a decent amount of debt, because our debt is leveraged. Leverage magnifies margins. This is kind of the baseline margin. This shows how much debt magnifies the margins here. 5-year average 9 plus 2.6 plus 3.8 plus 16.2 plus 9.2 equals, so 8.2. So I can tell again that they have a decent amount of debt. 8.2% rounded up, and I'll illustrate that when we get to the notes section down here. So ROE, so free cash flow to sales is next. 8.9 oops, wrong number. 9. So 0.9%. Damn it. Next is, oh, okay, so debt levels, cash levels. What I kind of do here is I just get a basic glance of the balance sheet first. 15, almost 16% of their balance sheet is in cash and cash equivalents, which is good. Debt, substantial. So they have about 40, what is that? 44% ish of their balance sheet is in debt, short and long-term debt, which is not great. But before we get to that, let's go to the cash conversion cycle. So 134.7. 2007. Let's make sure that is right, because I know some of these, oops. Where are we at here? Yep, 2007, so 32.1. $76.2%, which again is fantastic. I'll link below this video my other video about the cash conversion cycle and why this number is probably one of, if not the most important number on the entire preliminary analysis checklist that I talk about. I'll link that below this video. So again, we'll get back to the notes here. Let's do a basic EV calculation. So that, I mean, this is it. On a preliminary analysis, we'll go through the EV and EBIT calculations, which are 6.647. Okay, so here is where we're gonna have to Filipino peso to US dollars. So EV is market cap plus debt minus cash in its most basic form. It also includes minority interest and preferred shares, but most companies do not have preferred shares, which actually we might need to watch out for in this case because there's preferred dividend. So market cap 6.47, and I usually round up my numbers and stuff like that, so be aware of that while I'm calculating this, because 6470 is what I have on my calculator. Oops, 6471 in my calculator. To cash, and it's showing 0 cash, which I know is not true, so we'll go with this number. This is another thing you need to watch out for when you're evaluating smaller and or obscure companies, is sometimes they won't have the full numbers on here. So if this company passes my initial kind of screen, which is what we're doing now, Then we'll go to their actual financials and see how much cash they have on their balance sheet today. But I just kind of want to get a general idea, because most of the time this number is reasonably close if some of the numbers are missing. So again, make sure to, so this is in Filipino millions, Filipino peso millions. So 203,153. 203. Oops, I already forgot the number. 203,153. 153. So in billions of dollars, US dollars, that is, so minus 3,889. Again, I round up, plus debt 203,618. 618 plus 3,897 plus 327,747. 327,747 plus 626273 equals 12,752,000. And then they do have minority interest. So 1,662, and they do have preferred stock. So 1,897. $195, so plus 195. And again, I'm actually going to double check. I think you subtract minority interest from enterprise value, but I don't see minority interest very often in small companies. So to double check, I'm going to make sure. Plus minority interest, yes. So $166,248. So I can tell right now, 82, this company, at least on a relative basis, they have their current market cap is 6.47 billion. Their enterprise value is 16.129 billion. What does that mean when the company's enterprise value is more than its market cap? That the company has a lot of debt, and in this case, minority interest and preferred dividends as well. What this means is that there's a great likelihood that I'm going to find the company overvalued in a second, which we will do right now. 28781. So 551. So again, make sure to write this number down. 16,129. 1,129 is the enterprise value. Again, make a note of that down here as well. 16,129 divided by, what was it, 550 was the 551. 551. So yes, 29.27. I'm struggling to type today. 27. So again, I'll share with you what I look for here, but it is not that number. So go to the cash flow statement. Cash flow 18. We use this number down here. And again, you need to be cognizant that we use the trailing 12-month numbers here, which I think I just forgot to do over here, because used to be on the old Morningstar site, they had the trailing 12-month number total on the right, but instead they took that away, so we have to calculate it. So I need to go back and do that. 2876 781 plus 26434 plus 26409 plus 3175 equals, so that's 113,000 or billion, okay, Filipino pesos, 09, so 2164 is the actual number for the EV for the trailing 12-month period. So let's recalculate that. 16129 divided by 2164 equals 7.45. So that's a more reasonable number. I look for anything under 8, so 29 was insane, but obviously I calculated that wrong. So free cash flow, again, make sure calculate this right. 18186 plus 1726 plus 1295 plus 20374. So 68,800. 6688 811318. So this company isn't as overvalued as I expected. I look for anything under number 8 here. Why? A, it's worked for me in the past, produced great results, means the company compared to its enterprise value, its profitability, in this case EBIT or operating margin or free cash flow, its profitability compared to its enterprise value, including debt, total short and long-term debt, minority interest, preferred shares, and subtracting cash. Again, thinking as a total business owner is what this number represents, and there's preliminary analysis stage. I look for anything under 8 because that means the company, at least based on this specific relative valuation, there's a good chance this company is undervalued. Again, this number is under 8, this number is not. So what does that mean? It means the company could be potentially undervalued or about fair valued. We will find that out later in this analysis, but let's finish this before we talk about kind of what my thoughts are here. So the inverse, it's just the inverse here. So 164 divided by 13.4% and 8.2%. So I'm going to go back and make some quick notes on the balance sheet. 15.7%. Was about 44%. 44. Let's go 45 because you round up of it. Debt. Okay. So what I look for here on the preliminary analysis is I don't really look for anything in particular up here. These are just more for reference. I look for anything over 10% on a consistent basis here. So this is right at that number. 10% on a consistent basis means the company is on, at least on an operating margin basis, producing, I would say, good to great profitability on this metric over time. This number here, again, the company, I want to see the company share count falling almost 100% of the time. The only time this number should be rising is if the company is substantially overvalued. But in this case, it looks like the company is fairly valued or undervalued, so they've bought back about 32% of their shares in the last 10 years, which of course is part of the reason this has increased so dramatically. Or 2.5 times in about that same time period, which again is fantastic. Book value per share is a bit of a proxy for balance sheet strength and balance sheet value, at least in terms of assets and liabilities, the kind of net value of that. So what is the per share price? So right now, yeah, it's selling about book value right now. But again, that's just a basic proxy of the valuation of the net assets after subtracting all liabilities on the balance sheet. This rising over time is pretty much 100% of the time good. I can't think of a time where this would be bad other than goodwill and tangible assets rising a lot, which, let's go to the annual. Tangible assets rose quite a bit. That's not necessarily bad, but if there was a ton of goodwill on here, I don't like goodwill, so that would be bad. So in this case, it looks like their rise in book value and balance sheet strength is a good thing, at least again on a preliminary level. Okay, ROIC, I look for this over 10% on a consistent basis, so this is lower than I would typically look at. This again is just for reference because this ROE compared to ROIC, you can automatically tell there's debt. This I look for anything over 5% on a consistent basis, so this is great. So this number is good. We'd have to figure out what happened in the last 5 years, why they became so much more profitable on a free cash flow basis. They cut costs, they cut unprofitable locations. Did they raise prices? Do they have some pricing power, competitive advantages? Did they cut a bunch of staff? We need to figure out what is going on here because that is a pretty significant rise in free cash flow. We need to figure that out not only to see if this rise is sustainable, if this number is more sustainable or if this number is more sustainable, what's closer to the real truth, but also to see why, again, why that's happened. This, I'll link to the cash conversion cycle video below this. So you can watch that explanation because I go into full, I think it's about a 10-minute explanation on cash conversion cycle and why it's so important. This, we already talked about. I look for anything under 8. These numbers, the higher the better. Yeah, pretty much, that's as simple as that. Pretty much the higher the better there. And these are just some basic notes down here. So this company's a little up and down. Some of the margins and metrics fit my criteria, some don't. In this case, it's close enough to fitting my criteria, and this especially and this especially are very intriguing, along with this trailing 12-month number. So what I would do now is what we're going to do is we're going to continue analyzing this company step by step, trying to figure out if it's a good potential investment. Normally in this case, if something is kind of close, I just put on my watch list and put it a Google alert or some kind of stock alert if the share price gets to XYZ whatever I put it at, or the market cap gets to XYZ whatever I put it at, then I will research it further then. But because this one's so close, I'm going to actually research it, and we will do that in the next set of videos.